I want to explain why I am investing in oil right now, not because oil is exciting, not because I like making dramatic predictions, not because anyone is paying me to say it. I am looking at oil because when a system loses an essential input, the consequences do not stay inside that one market. They spread through transportation, food, inflation, interest rates, corporate margins, consumer confidence, and finally asset prices. That is how systems work. Most people look at oil and see a commodity chart. I look at oil and see a pressure valve inside the entire global economy. And when that pressure valve begins to fail, you do not wait until everyone on television agrees that it has failed. By then, the repricing has usually already happened right now. The world is facing a major oil supply shock, and most people are still behaving as if it is just another headline. That is the dangerous part. The issue is not only that oil prices have gone up. The issue is that one of the most important oil routes on Earth has been severely disrupted. Millions of barrels of daily supply are no longer flowing normally. Global inventories are being drawn down, and the market is still acting as if the buffer will last forever. In my experience, the biggest mistakes happen when people confuse a buffer with a solution. A buffer buys time. It does not remove the underlying problem. So I want to walk you through the logic calmly and clearly what is happening in the Strait of Hormuz, how much supply is actually being lost, why inventories are delaying the full price reaction, why oil could move higher if the disruption continues, and why, in my own portfolio, I see oil less as a speculative bet and more as a hedge against a possible stock market shock. The Strait of Hormuz is not just another shipping lane, it is one of the key arteries of the global energy system. Under normal conditions, roughly 20% of global oil supply passes through it. That means about 1 out of every 5 barrels of oil in the world moves through that narrow route. When you understand that number, you understand why this matters. A problem in that strait is not a regional problem, it is a global problem. Before the war, about 120 to 150 vessels could pass through that area on a normal day. That flow represented the quiet machinery of the global economy. Tankers moved, refineries received crude, countries planned their imports, prices reflected a system that, while imperfect, was functioning. Now that normal flow has been badly disrupted, shipping has slowed to a fraction of what it was. Some days, the number of vessels passing through has dropped towards 0 to 10. That is not a small change. That is a system going from normal circulation to partial blockage, and there are reasons for it. Tankers do not want to be hit, they do not want to be seized. The possibility of military escalation changes the risk calculation. Insurance companies either withdraw coverage or charge rates so high that the movement no longer makes economic sense. Navies become involved. Exporters become uncertain, buyers become nervous, and the physical barrels do not move the way they used to move. This is the part many people do not understand. Oil supply is not only about whether oil exists underground. Oil supply is about whether the oil can be produced, transported, insured, shipped, received, refined, and delivered to the right place at the right time. If one of those links breaks, the oil may technically exist, but the market cannot use it. That is where the present danger comes from. Under normal conditions, about 20 million barrels a day move through the Strait of Hormuz. Some of that is still getting out, some barrels are being rerouted, some countries have pipeline capacity, some exports are still moving in partial form, but the disruption is still estimated around 12 million barrels per Dalton Y. That is the number I keep coming back to, 12 million barrels per Dalton Y in a world that consumes roughly 100 million barrels per Dalton Y. That is about 12% of global supply. It is also about 30% of seaborne exports. To put that in perspective, the 1973 oil crisis removed about 7% of supply. This situation is closer to 12%. That is why some people are calling it the largest oil supply shock in history. Now, you can debate the exact number. Maybe it is 12, maybe it is 13. Maybe some flows improve for a few days and then worsen again. But when you are doing risk management, you do not need precision to understand scale. You need to know whether the order of magnitude is large enough to threaten the system, and this is large enough. Oil prices have already moved above $100 per barrel. But here is the important point. The price increase so far is not necessarily the full consequence of real shortages. It is the market anticipating shortages that difference matters. A price can rise because actual physical scarcity is already here, or it can rise because rational buyers understand that if the present disruption continues, actual scarcity will arrive. At this stage, I believe much of the move is still anticipation. That means the market is not yet pricing the full consequences of a long disruption. It is pricing fear, it is pricing probability. It is not yet pricing a complete physical squeeze. And if the war drags on and if the Strait of Hormuz remains restricted, the market may need to move from pricing fear to pricing reality. That is when things can change very quickly. Oil is governed by supply and demand. That sounds simple, but most people forget what it means during a shock. If supply drops sharply and demand remains the same, something has to adjust. Either new supply appears, inventories fill the gap, or prices rise high enough to destroy demand. There are no magic solutions in a physical commodity market. If the world needs 100 units and only 88 units are available, then either somebody finds 12 new units or somebody stops consuming. Price is the mechanism that decides who stops. That is what demand destruction means. It is not a phrase from an economics textbook. It is the way the system forces consumers, companies, and countries to use less when there is not enough to go around. At $100 oil, some demand may soften. At $120, more demand may soften. At $150, the pressure becomes much more serious. But I do not believe $130 automatically solves a 12 million barrel per Dalton-wide disruption. I do not believe $150 automatically solves it either if the disruption is prolonged and inventories keep falling. That is why the upside risk in oil cannot be dismissed just because the price already moved. People often think oil is already over $100. Therefore, the move is done. That is not how supply shocks work. A price chart does not define the ceiling. The physical balance defines the ceiling. And right now, the physical balance is under stress. So why has oil not already exploded to record highs? Why are we not seeing a full panic? The answer is inventories. Inventories are the buffer. They are the reason the market can pretend for a while that the problem is manageable. At the start of the year, global oil inventories were around 8.4 billion barrels. That includes commercial storage, government stockpiles, tank farms, refineries, terminals, floating storage on tankers, and strategic reserves. That sounds enormous, and it is enormous. But there is a critical difference between oil that exists somewhere and oil that is available to the market in the right form, in the right location, at the right speed. Most people hear 8.4 billion barrels and assume the world has a comfortable cushion. I do not see it that way. I see a large number with serious constraints. A portion of that oil sits in strategic reserves. Governments hold those barrels for emergencies. They may release some, but they will not release all of it. Strategic reserves are not meant to become permanent daily supply. Another portion is in the wrong place. Oil stored in one region does not automatically solve a shortage in another region. If Europe needs oil and barrels are trapped on the wrong side of a disrupted shipping lane, that inventory does not fully solve the problem. Then there is release speed. Even if you wanted to release hundreds of millions of barrels quickly, the logistics are not simple. You need terminals, you need tankers, you need trucks, you need pipelines, you need crews, you need refineries that can process the specific type of crude. You cannot simply say, release 1 billion barrels next week and make it happen. The physical world has bottlenecks. The paper market can reprice instantly. The physical market cannot move instantly. That mismatch is what creates sudden shocks. Some oil is not even immediately market ready. Crude grades matter, refinery configurations matter, transportation routes matter. A barrel is not always a barrel if the refinery that needs supply cannot use that particular crude type. So when analysts ask how much of the 8.4 billion barrels is actually drawable, the estimates vary widely. Some estimates are around 800 million barrels. Other estimates from agencies and broader definitions reach 2.5 or 2.8 billion barrels. The exact number is uncertain, but the core problem is not uncertain. If 12 million barrels per Dalton Y are missing from supply, then in 100 days the system would need about 1.2 billion barrels from somewhere. That is the math. A 12 million barrel daily draw becomes 360 million barrels in a month. It becomes more than 1 billion barrels in roughly 3 months, and the panic does not begin when the last barrel is gone. Markets do not wait for zero. They panic when inventories fall to levels that make the next shock unbearable. They panic when refiners worry about supply. They panic when buyers compete for the same physical barrels. They panic when governments realize strategic reserves are no longer a comfort. They panic when the buffer stops feeling like a buffer. That is why I believe the inventory story is central. The reason oil has not skyrocketed more violently is that inventories are still absorbing the shock. But if the disruption continues, the buffer gets smaller every day, and when a buffer shrinks quietly, the market can appear calm until suddenly it is not calm at all. This is a pattern I have seen many times in markets and economies. People see stability on the surface and assume the system is healthy, but sometimes the stability exists only because hidden reserves are being consumed. When those reserves are gone, the adjustment can be sudden. that is what I am watching. I am watching the Strait of Hormuz. I am watching the barrels, I am watching the inventories, I am watching whether the market continues to underestimate the duration of the disruption. Now let me talk about price. Over most of the past year, WTI crude oil was trading around the $60 range. Then the shock began to change expectations. Oil moved sharply higher. It reached levels above $100. I did not want to chase the first move. That is important. Even when I believe in a thesis, I do not like to buy simply because a chart is going straight up. I want to understand the cause, the probabilities, and the asymmetry. So I waited for a pullback and initiated my position around the 20th of April. That was my decision. Not because I knew the future. Nobody knows the future. But because the risk-reward changed in a way that made sense to me. The question people ask now is whether it is too late. Can oil still go higher? And if it can go higher, how much higher? To think about that, you have to look at history and inflation. In 2008, oil reached around $147 per barrel. That happened without a disruption of this scale. And $147 in 2008 is not the same as $147 today. After years of inflation, that price in today's dollars would be far above $147. It would be well over $200 by simple inflation adjustment. So if oil is around $100 to $110 today, and the world is facing what may be one of the largest supply disruptions in modern history, I do not see how anyone can say the upside is impossible. That does not mean it must happen. Markets are probability distributions, not certainties. But if the war continues, if the strait remains restricted, and if inventories keep falling, the supply and demand dynamic suggests that $100 oil may not be the final price. It may be an early stage of repricing. Again, I am not making a wild all-in bet. That would be inconsistent with how I think. The goal is not to predict perfectly. The goal is to build a portfolio that survives multiple scenarios. That is the real reason I am investing in oil. I believe in long-term investing. I want to stay long assets like equities, metals, and long-term productive investments. I do not want to sell everything because of one geopolitical event. That is usually how people make bad decisions. They react emotionally, they abandon the plan, then the crisis resolves and they miss the recovery. But I also do not want to pretend that a major oil shock cannot hurt my portfolio. If oil spikes sharply, it can push inflation higher. If inflation rises, interest rate expectations change. If rates remain high, equities can be pressured. If consumers are hit by higher fuel and food costs, spending weakens. If margins compress, earnings weaken. If earnings weaken and discount rates rise, stock prices can fall. That is the chain. Oil does not need to destroy the world to hurt the stock market. It only needs to tighten financial conditions and pressure the consumer. So I ask myself a simple question. If oil prices spike and the stock market drops 20 or 25%, do I want to have a position that offsets some of that damage? For me, the answer is yes. That is why I treat oil as a hedge. Yes, I may make money if oil rises. But more importantly, if oil rises for the wrong reason and risk assets fall, that oil position can cushion the portfolio. If my overall portfolio is down 5 or 10% instead of 20 or 30%, that matters. It gives me emotional stability, it gives me capital, and if the oil trade works because the stock market sells off, then the profits from oil can be used to buy the dip in long-term assets. That is the second part of the logic. A hedge is not only about reducing losses. A good hedge can create liquidity at the moment other people are forced to sell. That is powerful. When fear is high and assets are cheap, you want cash, you want optionality, you want the ability to act. Most people do not have that ability because they are fully exposed to the same risk everyone else is exposed to. They are forced to watch losses or worse. They sell the wrong assets at the wrong time. If oil rises because of a supply shock while equities fall, the oil hedge may give me dry powder. That is the kind of portfolio construction I care about, not predicting, preparing. Now, I want to be clear about the risks. This is not risk-free. Oil can fall. The biggest risk is de-escalation. If the conflict cools, if the Strait of Hormuz reopens, if ships begin moving normally, if insurance markets normalize, then supply can return and oil prices can fall quickly. That is real. No responsible investor ignores that risk. You can be right about the importance of oil and still lose money if the timing or scenario changes. That is why position sizing matters. That is why I do not see this as a reckless bet. I see it as a hedge against a specific systemic risk. The second risk is that inventories last longer than expected. The world may find more rerouting than assumed. Governments may release enough reserves to calm the market, demand may weaken on its own. A slowing economy could reduce consumption, the supply shock could be partially offset by lower demand. That is possible. Another risk is political intervention. Governments do not like oil shocks. They will try to use tools to prevent panic. They may release reserves, they may pressure producers, they may provide military escorts, they may negotiate temporary corridors, they may do things that change the short-term balance so the trade is not one-directional, but the existence of risk does not mean the opportunity is not real. Every investment is a choice among risks. Holding only stocks has risk. Holding only cash has risk. Ignoring oil during a supply shock has risk. Buying oil has risk. The question is not whether risk exists. The question is which risk you are being paid to take and which risk you are exposed to without realizing it. Right now, I believe many investors are unknowingly exposed to the risk of an oil shock through their equity portfolios, their living costs, and their inflation exposure. They own the consequences of higher oil, but they do not own the thing that may rise if those consequences appear. That is the imbalance I am trying to correct. When I look at the geopolitical side, I do not see an easy solution. The United States is far stronger than Iran militarily, that is obvious. But strength does not mean costless victory. A lion can be stronger than a porcupine and still get badly hurt trying to attack it. Iran's geography, military assets, regional influence, and ability to threaten energy infrastructure make this difficult. Can the United States force the Strait open militarily? In my opinion, yes, if it chooses to pay the price. But what would the price be if military action escalates? Iran could target oil infrastructure across the Gulf. If that happens, reopening the strait may not solve the supply problem in the short term because the facilities needed to produce and export the oil could be damaged. That is the issue. People talk about reopening the route as if the route is the only problem. But in a severe escalation, the assets feeding that route can also become targets, ports, pipelines, terminals, refineries, production facilities, tankers. The energy system is a network, and networks can fail at multiple points. That is why I do not take the situation lightly. I do not assume the conflict will be solved cleanly. I do not assume the market fully appreciates the consequences. I do not assume inventories can handle the problem indefinitely. And I do not assume that stocks are immune simply because they have recovered from other shocks before. The right way to think about this, in my view, is through probabilities and second-order effects. First-order effect. Tankers do not pass through the Strait of Hormuz. Normally, second-order effect, oil supply falls. Third-order effect, inventories are drawn down. Fourth-order effect, oil prices rise to destroy demand. Fifth-order effect, inflation rises or remains sticky. Sixth-order effect, central banks have less room to cut rates. Seventh-order effect, consumers and companies face higher costs. Eighth-order effect, risk assets reprice. That is the chain. You do not need every link to break for the portfolio impact to be meaningful. You only need enough pressure to change expectations. Markets move when expectations change. So the question is not whether oil has already gone up. The question is whether the future path of oil is still underpriced relative to the probability and severity of the shock. I think it may be, and that is why I am positioned. There's another lesson here that applies beyond oil. Most investors are bad at thinking in systems. They isolate events. They say oil is oil. Stocks are stocks. Inflation is inflation. War is war. But in reality, these things interact. A shipping route affects oil. Oil affects inflation. Inflation affects rates. Rates affect valuation. Valuation affects stock prices. Stock prices affect consumer confidence. Consumer confidence affects spending. Spending affects earnings, and earnings affect markets. Again, everything connects. The economy is a machine. Markets are part of that machine. Geopolitics affects the machine. Commodities feed the machine. Debt and money move through the machine. If you only look at one gear, you miss the whole engine. Oil is one of the gears that can seize the system. That is why it matters. And that is why I am not looking at this as a short-term headline trade. I am looking at it as a potential shift in the balance of risks. If the war ends and oil flows normalize, I will reassess. If inventories stop falling, I will reassess. If the price moves too far relative to the risk, I will reassess. If equity markets begin pricing the shock correctly, I will reassess. Good investing is not about marrying an idea. It is about updating as reality changes. But right now, the reality I see is this. A critical oil route is disrupted. A large amount of daily supply is impaired. Inventories are being used as a buffer. That buffer is not infinite. Oil prices have risen, but not to levels that necessarily destroy enough demand if the disruption persists. The stock market may be vulnerable to a renewed inflation shock, and an oil position can serve as a hedge against that vulnerability. That is enough for me to take the risk in a controlled way. I also want to be direct about psychology. Most people do not hedge when hedges are cheap or reasonable. They hedge after the damage is obvious. They buy protection when fear is already extreme. That is usually when protection is expensive. The better time to think about protection is when the system is still pretending everything is manageable. Not because you are certain disaster will happen, but because you understand that the cost of being unprepared can be much higher than the cost of carrying a rational hedge. I would be happy if the war ended. I would be happy if the Strait reopened. I would be happy if oil prices fell because supply normalized and the rest of my portfolio continued higher. That is not a contradiction. A hedge is not a desire for disaster. It is protection against disaster. The goal is not to hope for a crisis. The goal is to be less damaged if a crisis happens. If the war ends, the hedge may not work, but the rest of the portfolio may benefit. If the war escalates, the hedge may help offset the damage. That is a balanced way to think. Too many people think investing is about choosing one future and betting everything on it. That is not how I think. I think in probability. I think in scenarios, I think in systems, and I want to build a portfolio that can survive being wrong. Oil is part of that right now, not forever, not under every condition. But under this condition, because this is not a normal environment, the Strait of Hormuz is not functioning. Normally, the volume of missing supply is not small. The inventory draw is not harmless. The price action is not only a technical move, and the risk to the broader market is not imaginary. When I bring all of that together, the conclusion is straightforward. I am investing in oil because the system is under stress, because the market may be underestimating the duration and severity of the shock, and because oil can act as a hedge against the kind of inflation-driven equity sell-off that could follow if the situation gets worse. That is the logic. No hype, no certainty, no promise, just a clear chain of cause and effect. And as always, the key is not to copy anyone blindly. The key is to understand the machine for yourself. Ask what is happening. Ask what second order consequences follow. Ask what your portfolio is exposed to. Ask what hedge, if any, makes sense. Ask what position size lets you sleep at night. Ask what conditions would prove your thesis wrong. Then act with discipline. That is the difference between speculation and risk management. Speculation says, I think oil will go up, so I want to make money. Risk management says, if oil goes up for the wrong reason, many things I own may go down, so I want protection. That is the distinction. And that is why, in this moment, I am investing in oil. Not because I know exactly what comes next, because I do not, but because the balance of risks has changed. And when the balance of risks changes, a serious investor has to change with it. The worst mistake is to pretend that because something has not broken yet, it cannot break. The second worst mistake is to wait until it breaks before doing anything. I do not want to make either mistake. So I am watching the Strait of Hormuz. I am watching inventory levels. I am watching the price needed to create demand destruction. I am watching whether the conflict de-escalates or spreads. I am watching whether the stock market continues to ignore the risk. And I am keeping my oil exposure as a hedge, not as a religion. If the facts change, I will change. But until then, I would rather be early and protected than late and exposed. That is the principle. And in markets, principles matter most when the world becomes uncertain.